Hello, good morning everyone. Thanks very much for participating in this session. Very quick slide to show you the obligatory regulatory information. While you're having a chance to read that, let me just introduce myself. I'm Dan Higgins. I am the founder of Marylebone Partners. We're a London-based investment firm that is shortly to become part of Brown Advisory. Before I give a quick summary of our approach and why we feel it's so relevant today, let me just explain what Majedie is and what we do. So we were appointed as the new manager of Majedie in early 2023. And after our appointment, the board moved the official objective to an inflation plus mandate, which is inflation plus 4% total return. That includes a dividend which has been set at around 3% a year. And we moved the investment approach to what we call a liquid endowment model. So allow me to explain what that means. The endowment element alludes to the very long-term fundamental mindset that is behind the success of the elite university endowments, mostly in the US, and has served them so well for many years. So that means very long-term, no market timing, no low return asset classes in the portfolio, and a willingness to embrace differentiated and sometimes alternative return sources. We think those are the ingredients that are required to deliver really good inflation beating returns over time. But unlike the big university endowments and some of our peers in the investment trust sector, we don't invest in deeply illiquid or unlisted strategies like private equity or venture capital or infrastructure or real estate. Everything we invest in is marked to market regularly. And that's important, I think, for two reasons. The first is, first and foremost, in our opinion, we don't believe you need to lock money up for 5 or 10 years to deliver good inflation beating returns. But secondly, and this is really relevant within the investment trust sector, shareholders can have real confidence in Majedie's net asset value when they are making a decision to invest. So in our opinion, and one of the many reasons that we think Majedie is a very relevant investment trust today, is that it has the criteria we think are required. There's the investment criteria, which is we're using the investment trust structure to give shareholders access to differentiated return sources. And second, from a commercial point of view, we're giving something that you couldn't find elsewhere. We think it represents really good value for money. It's marked to market regularly, so you can really trust the NAV. Let me go into a bit more detail about what's actually in the portfolio and why. So we have 3 component strategies within Majedie. The first of these, the largest, are around 60% at present, and I think that's probably the upper end of where we'll get to for this strategy, is what we call external managers. And as the name suggests, here we allocate out to a selection of third-party funds that are run by world-class fundamental investors. And each of these investors is a specialist in a sector, in a region, or operates with a very specific style bias. They all work at independent boutiques. And in many cases, in fact, I think I'm right in saying in the majority of cases, these funds are closed to outside investment. They certainly don't operate elsewhere within the investment trust format, but we can get access to their talents for you as Majedie's shareholders. The second component of the Majedie portfolio, currently around 15%, and we believe heading towards 20%, we call special investments. And I think of the 3, we think everything we do is differentiated, but I think special investments is arguably the most differentiated and idiosyncratic of the 3. So these are opportunities to invest alongside some of the world's great investors in their highest conviction individual ideas. It might be a co-investment in a public company. It might be a thematic opportunity. It might be a specific special purpose vehicle that's been set up to pursue a certain opportunity. And we have 3 rules for our special investments. The first is they must come from a trusted source. So 1 degree of separation. If we know someone who knows someone, that's okay, but we don't just want to be on the receiving end of marketing pitches. Second, these situations must have high return potential. And for us, that means the prospect of returns of at least 20% or more per annum. So quite ambitious return requirement. And third, we must feel we can monetize them within 36 months or less, which comes back to this no deeply illiquid strategy. So the investment trust structure enables us to be patient, but we do not believe it requires us to be in deeply illiquid areas or areas where pricing is subjective. And then the third of our 3 strategies, direct investments, also around 15%, and we expect that to increase a little bit as well. We run a book of very focused direct investments in public equities, 8 to 12 names, and we select these names for their quality, but there's also always an element of unappreciated change, which means we can buy quality at an attractive price. So rather like the last presenter, you will not find any of the household name quality growth stocks in our portfolio, and certainly not in the direct investments component. It is truly differentiated underlying investments. Quick word on performance since our appointment. Since we assumed management, we've delivered very solid performance. It is ahead of the CPI plus 4% target. I should point out these are total returns, so inclusive of a 3% per annum dividend. It's also worth pointing out that we paid off a historic debenture at the start of this year, and that will save Majedie's shareholders around 0.75%. We subscribe to the Warren Buffett view that if you're good, you don't need leverage, and if you're not good, you certainly shouldn't be using it. We don't believe structural leverage is required to deliver the sorts of returns that we're reaching for. We do have a cash settlement overdraft facility if we needed to take advantage of short-term dislocations. And for the calendar year, 2025 calendar year, Majedie's NAV is up by a little under 12%, all in sterling, importantly. You should think of this as a sterling investment. Full details of attribution over this period are on our website. I think the important thing to convey in this forum is that returns have come from across the 3 strategies, and with close to 0 exposure to Magnificent 7 stocks and the other very popular areas. So we do believe that Majedie, within the context of your own portfolio, Majedie can act as a source of performance, we hope, but also diversification and complementary return sources. The bottom chart here shows you the premium and discount to NAV. And as recently as April, Majedie traded at a small premium to NAV, which I think is an indication of the appetite and interest in what we're doing. In the last few months, the discount has widened out again, along with a number of other investment trusts, really because the NAV has gone up and there's been a little bit of a hiatus in terms of buying. Frankly, that's why we think now is a great time to be looking again. The share price is what we all care about. We are investors in Majedie. It so happens I bought a few shares from my ISA quite recently, and we are incentivized by the share price, not the NAV as well. Our fees are based on market cap, not on NAV. So there's true alignment here. And finally, I should say we just agreed as part of the forthcoming tie-up with Brown Advisory to demonstrate that alignment to reduce fees by around 10%. basis points. So these are all the reasons that we're feeling very positive about Majedie's future. Why do you need Majedie in your life? I think it's simple. The world has changed, and none of us can assume that interest rates are going back to where they were. None of us can assume that markets will rise indefinitely, or that a small number of growth stocks, nearly all of which are listed in the US, will always outperform. We cannot assume that the dollar will always outperform everything else. So the chart on the left shows you quite how much capital has gone into US assets since the global financial crisis. And as we all know, that's led the S&P to outperform everything else. It's led the dollar to be by far the strongest major currency in the world. We think there are many scenarios in which that will not recur. And at the same time, in the new regime that we believe we find ourselves in, we are seeing more dispersion under the surface of markets. And really importantly, that's being driven by fundamentals. So for the first time in living memory, we are seeing more divergence in the performance of different securities. And it's not just being driven by sentiment or flows, it's being driven by fundamental factors. And that's why we believe the opportunity to find differentiated return sources, to own the winners and avoid the losers, is as good as we can remember for a very long period. We are not apologists for active management as an industry, but we do believe the opportunity set for the best active managers is as good as we can remember. So to succeed, one has to look beyond the obvious areas. The returns may well be higher, and critically, the risk could actually be lower. And the good news is there's an awful lot out there that has been overlooked, and we are specialists in finding those opportunities. So over the next 5 slides, I'm going to highlight 5 of the areas where we see the most opportunity. In every case, you will see that we believe expectations are modest, but fundamentals are improving. The rate of change is positive. I think that's going to be extremely important over the months and years ahead. When valuations are high, even a small negative rate of change in expectations can hurt a lot. And when they are low or reasonable, a positive rate of change can have an amplified positive effect. That's what we're trying to capture. The opportunities I'm going to talk you through represent about 60% of the portfolio in total. So 2/3 of our portfolio. I'm not going to spend much time today talking about the other third, which is mostly anchored in high probability, slightly less dynamic absolute return situations. For us, most of that relates to specialist credit opportunities. I want to focus today on the areas that we believe can make really strong absolute returns, largely independent of what's going on in markets, to focus on the upside. But please be assured, we put capital preservation first. For us, that's the absolute key to long-term compounding. Okay, so let's do the first of these. 5 areas where we think we can provide something really differentiated for Majedie shareholders. The first of these is Asia. Collectively, between 15 and 17% of the portfolio is invested in Asia. 2 areas that we feel particularly excited about. Let's start with China. We have visited China twice in the last 18 months. My colleague James is in the region as we speak. The first time we visited, it was beginning to become apparent to us that the Chinese authorities were determined to stabilize the economy and that they had the tools to do so. It was also obvious to us that they wanted to do so in a measured and lasting fashion. It was not as simple as just reflating the real estate bubble, which had caused a lot of the problems that the country was trying to deal with. When we went more recently, and feedback from James's trip on the road right now, it's that things have evolved, and they've evolved meaningfully. And I think whereas a year ago, a lot of commentators felt they understood China's problems more than the Chinese themselves, we are now suddenly seeing a lot of interest in what's going on there, and an increasing view that the stabilization and policy measures in China are beginning to work. It's quite nuanced. There are three legs to the policy. The first, and you see a pretty extraordinary chart on this on the left-hand side, relates to the consumer. Household savings in China are extraordinarily high, and yet household portfolio investments in equities are very low. Around 5% of the typical Chinese household is currently invested in their domestic equities market. Through a whole series of policy announcements, which range from trade-ins for your white goods and cars to interest rates being reduced, the Chinese authorities are trying to channel some of those savings into the real economy, and the stock market is an important conduit in that respect. So the first is the consumer and the stock market as a tool to channel the consumer savings into the real economy. The second is AI infrastructure. The Chinese are reckoned to have invested around $100 billion equivalent into AI this year. That's around a quarter of what the US is investing in AI. But in China, the investment is very much focused on infrastructure, not on model development. So it's less of an entrepreneurial opportunity in China. AI is seen as a national utility that will provide support for society as a whole. So that's a very important dynamic under the surface of the market. And the third area where we see policy and opportunity is in what the Chinese are calling anti-involution measures. And what that means is there are critical sectors like steel or electric vehicles or batteries and the solar industry that have historically been uneconomic for China. They've had huge market share but not made profits, and they realize that has to come to an end if they're to avoid a Japanese-style deflationary spiral. So there are certain industries where you're seeing price stabilization, and we think there's a lot of opportunity as well. We are expressing this view within Majedie primarily through a manager called Perseverance, based on the ground in China. We also have some supplementary investments. One of our special investments is an anti-involution play, and through secondary beneficiaries, which I'll talk about in a second. The second area where we have exposure in Asia is Japan. Japan, that obviously is an area of big structural change. For the last couple of years, we felt that there's a transformation going on in the corporate and market level. It's working. Something like 88% of prime listed companies in Japan have now disclosed their plans for greater capital efficiency, how they're going to get their price to book ratio up. Japanese companies have announced 18 trillion yen of buybacks last year. That's double the previous year. Dividend payments are up. 50 plus companies are facing activist proposals. We think there's more to come, but we also think a lot of the low-hanging fruit has probably been picked. So our participation in Japan is primarily through a small cap activist manager called Strategic Capital. To extend the metaphor, if a lot of the low-hanging fruit has been picked, Strategic Capital have a step ladder that helps them get to some of the higher hanging and arguably juicier fruit, which is through their own active engagement, unlocking value from within companies. They own 10 to 12 stocks at different stages of activist campaigns and very much still believe that 20% IRRs are achievable from their portfolio. So that's number one, selectively in Asia. The second is with respect mostly to our direct investments, but also some of the external managers, which is we feel there are some really attractive stock picking opportunities closer to home. And I was interested in the comments made by the previous presenter, but I was also interested to see that we, whilst we concur with the opportunity set, we just happen to own a selection of different names. I would say we're pretty pessimistic about the economic and certainly political situation in the UK and in continental Europe, but that doesn't mean there isn't opportunity. This is where we're most likely to find high quality companies at reasonable prices. So more than half our direct investments are based domestically. We own IMI PLC, a company called DCC, which we think is the least well understood component of the FTSE. In Europe, we own a company called Stabilis, another one called Cancom, plus the two stocks that we've highlighted here. Weir Group is a classic sheep in wolves clothing. It's still categorized by many as an oil services business, but in fact has really high quality recurring revenues as a leader in mining supply and services, serving copper and critical minerals. It has terrific profit margins, EBIT margins at nearly 20%, free cash conversion of around 100%, good balance sheet. It's made good bolt-on acquisitions. It's a super company at a reasonable valuation, as is the one on the right, Computer Centre PLC. It's our largest single direct holding. Great company that helps large enterprises with their IT infrastructure, high visibility, recurring revenues, really high barriers to entry. It's got 500 million quid's worth of net cash on the balance sheet, returned over £1 billion to shareholders over the past decade. Trading statement a couple of weeks ago reaffirmed what strong order book they've got in all regions, growth ahead of expectations, and they're a real beneficiary of all the capex that's going on from hyperscalers in the US. And you can buy into this growth and cash generation for a PE of around 13 times next year's earnings. So I should also add we've got further exposure to idiosyncratic stock picks in Europe from a European manager within our external manager category called Helicon, an international manager called Briarwood. Overall, we've got high teens exposure in Majedie to European stocks, including UK stocks. The message here is markets may be expensive, not all stocks are expensive, and there are reasons to believe that the attractions of these companies will come to the market's attention in the not too distant future. Opportunity number 3, in the US. In the US, it is not so hard to find positive earnings growth, but there's no doubt market expectations are generally speaking somewhat higher. The S&P 500 is on 23, 24 times forward earnings. In our opinion, AI and related areas are definitely frothy. I was in San Francisco at the beginning of last week meeting some of our external managers, and whilst the level of excitement and belief that AI is going to transform not just the prospects for individual companies, but the economy, it was palpable. There was also I would say a general lack, not amongst our managers, but a general lack of concern about valuation levels. And so we do not have exposure to what we think are the frothy components of the US market. In the US, I think if you want to put capital to work, which has opportunity of high returns but a margin of safety, you need to look at areas that have been a little bit under clouds. So 2 of these, I'm conscious of time, so I'll talk quickly. The first is biotech. Sectors lag because of concerns that the new administration is not pro-science. Huge price dispersion between companies that have commercial products out there and those that are in clinical stage. Our manager, Paradigm, owns clinical stage companies that are about to become commercial stage. Their portfolio is full of those opportunities. Software is the other area where you can find great companies with earnings growth at great valuations. We got involved in 2022. We think you've got a second bite of the cherry because the market's really concerned about AI and its impact on companies. It will affect some, it won't affect them all, and we're beginning to see M&A, and our exposure there is primarily through a manager called Presidium. Number 4, quickly, real assets. There are certain areas of the commodities complex where we just feel demand is going to be a lot greater than supply. The 2 that we're most excited by are copper, entering structural deficit, as you can see here, demand from renewable energy, electric vehicles, power, grid upgrades, data centers. Growth is going to be demand growth 5 to 6% higher over the next 3 years, a deficit of between 300,000 and 500,000 metric tons. That means prices have to rise to meet that demand. We've primarily been capturing that through a basket or ETF of copper equities, and we've been invested in the listed uranium space for several years. Again, more demand than supply. 30% of utilities uranium requirements are uncontracted. That's going to increase by a third next year. 40 to 50 million pound deficit. Contracts are being struck at higher prices, and obviously it's an essential ingredient for nuclear power generation. So that one through an external manager and a basket approach as well. And finally, for fear of overrunning, special investments. These are just two of the ideas we've done recently. The first is a co-investment in a US listed company called CVS Health. The thesis here is simple, that the company hadn't lived up to its potential, particularly in pricing its health insurance business. A manager we've known for many years called Glenview in the States is now on the board and starting to turn things around. And we're really beginning to see the benefits of that in the share price. Glenview's gone on the board. Profitability is improving. The one on the right, very different. This is a very stable, high-quality business based in Brazil, a waste management company with contractual revenues, kind of utility-like profile with lots of upside in the form of biomethane, carbon credits that they can sell on to companies like Google as they want to offset their own carbon footprint. So as you'll tell, very eclectic. Other ideas we have in this space are more thematic in nature. Here's a summary of the overall portfolio. We can come back to this again, but it's all on the website. Bring it together. Very differentiated. No Mag 7 names here. Focused in terms of position sizes. We're not over diversified, but there's true diversification in terms of return source. The cross correlation between our investments is very low. Return potential in our portfolio varies between 10% and much higher than that in the case of the special investments. Money's working hard, cash levels are low, but liquidity is good. And I've just about hit my timing limit. High conviction portfolio, non-consensual, stuff you won't find anywhere else. It's a sterling asset. It's mark to market, so you can trust the NAV. And we think this is a great environment for what we do. We're capital constrained, so we're enjoying life at the moment, despite all the existential things we have to worry about.
Thank you very much, Dan. Really comprehensive presentation there. Thank you. We have got a couple of questions, and we'll just try and squeeze those in there. I mean, there are some more, but I don't think we'll be able to fit them all in. One question here from Stephen. Do you see any risks in Taiwan at the moment, given what's happening there?
I hesitate to say in a semi-public forum that the Chinese are not about to invade Taiwan. Yes, there are risks. I think on a 10-year view, there will be a moment when we are really deeply concerned about it. I don't think now is the time. I think the Chinese want stability over philosophy right now, but the day will come.
Thank you very much. And one just here from James, who asked, how are you positioning for higher interest rates? That I was picking up on the slide earlier on in the presentation.
So the short answer to that question is we shouldn't be immediately affected by higher interest rates because we don't own a lot of long duration growthy investments that would be sensitive to higher discount rates. Higher interest rates, I think, would benefit certain parts of the portfolio. So the commodities exposure I mentioned and the specialist credit aspect, which we didn't really talk about, that would be good news for that part of the portfolio. So I would say neutral to favourable so long as they go up in a measured fashion. I think my personal view is probably short-term interest rates will come down and longer-term interest rates will rise, and that should be just fine for us.
Thank you very much. Just one more, Dan. We'll try and squeeze this in before the end. There's a question from James here, who's picking up on the quality aspect that you seek out. And he asked, what are the main gauges of quality that you use?
For us, it is structural growth, so that companies that are growing, companies that have good levels of business profitability. The single best measure for that is probably return on capital measures, which means they generate cash earnings, good quality management teams, good balance sheets. So we don't like leverage either at companies or in the portfolio or amongst our managers. The key is knowing what to pay for those qualities and attributes.